Thanks for tuning in to the All Funds Network. My name is Mike Schroeder. Today we're here with my co-host Skyler Steinke, and we're joined by Ryan Soury of Usher Labs. Ryan is the founder of Usher Labs. It's soon to be launched Fiat Protocol. Ryan is an engineer and a researcher. So Ryan, thanks so much for joining us, man.
Thank you for having me.
Absolutely.
Yeah.
Let's kick it off with the fun one. Maybe just start by talking about what's your crypto journey. How'd you get into the space? When was your first, light bulb moment in crypto?
Yeah. So I've been touching crypto since probably 2017 as a casual sort of investor slash early meme enthusiast. Uh, I think the biggest light bulb was a time when I went to a bank branch and they charged me fees for doing a transfer that was like substantial. And just the delays and headaches involved in that, and the comparing that user experience to what you can do with stable coins, or even like Bitcoin or Ethereum, etc., and realizing that there's this like gap between, I guess the banking infrastructure and then like totally sovereign capital management, which is what you get out of cryptocurrency. And so,
Mhm.
yeah, that was basically the light bulb, where I realized, hey, I want to be part of this. I think there's something here, and it has a place in the future. But I didn't know how it was going to be adopted, like whether it was going to be introduced through the institutions, or it was going to be this crypto funk sort of um, you know taking over the institution sort of idea. I guess now it's like a balance of both, which is good.
Yeah.
Cool.
Yeah,
Balance is always
definitely.
good.
You found out about crypto, and then how'd you start getting in the industry? Maybe tell us the story of Usher Labs.
I started developing or committing to developing sort of smart contracts. Earliest project was trying to do some NFT stuff. I actually was creating like AI generated images before LLMs took over the entire like mind share, like if you want to use that word.
Hmm.
Just strapping together like face app with like Snapchat camera and all of this hacky stuff to make NFTs. But then I realized, hey, there's maybe a lack of marketing tools, and that led into the journey. And I got the opportunity to participate in RWAves Open Web Foundry program, and they gave me basically a foot in the door with a bit of the other teams, some of the industry players, and our first VC deal, which was a good experience. And from there, it's been a bit of a snowball, realizing with better data engineers, realizing that there's a gap in the market for data infrastructure and security in relation to blockchains. And then, how does that data impact actual financial outcomes, which is sort of where we're at now.
Now with Usher Labs, talk to us about that problem. I guess maybe just start with talk to us about the problem that you guys are really solving.
Yeah. So Usher Labs is ensuring that, Web3 is secure with trusted data. So essentially it's how do we identify who we can trust with respect to, first party data? And how do we build out pipelines, like data pipelines that allow us to leverage that data? And the philosophy here is like, websites started as static web pages and evolved into data driven web applications. And smart contracts are fundamentally doing the same thing. Polymarket is powered by data from the outside world. How it gets that data is its own infrastructural solution. But what you get is like this permissionless, prediction market. So Usher Labs is developing an infrastructure platform that builds on what's referred to as ZKTLS. And it's a way for us to
Hmm.
build these data pipelines and data flows from centralized exchanges, from banks, from, financial institutions, healthcare, related institutions, build out these proofs that guarantee to a blockchain that the data came from this highly trusted source. Now, that's the infrastructure layer. And then what we're doing on
Hmm.
top of that with Fiat is applying that. So, we're shipping that infrastructure to a few partners. We work with Truflation, we work with Chainsight, we've worked with Roach Network in the past, for example, to leverage that infrastructure. But Fiat Protocol is really us saying, okay, how do we, let's start with something radical, a problem that I hold dear, like foreign exchange fees. Why can't we use crypto rails for foreign exchange. And the rabbit hole goes so deep as to say, like, automated market makers only account for liquidity that is locked, and doesn't account for liquidity that exists, that can be settled, that exists in centralized exchange accounts or bank accounts. And the reason why it doesn't is because there's no way to trace it. So it's like, now we're really like taking that infrastructure, applying it into a paradigm where we can, affect the spread, the cost associated to listing on decentralized exchanges and so on. So that is how it's materializing into fiat.
Yeah. Okay, so there's two sides of the business. So the first side is really ensuring that high quality data for these Web3 applications. And then the second side is kind of fiat on ramp. Is that kind of, or on ramp might be the wrong word. Kind of, how do you think about that?
Yeah, so fiat is more, you can think about it like an on-ramp. If we work with the stablecoin issuers, you can on-ramp with the stablecoin issuer for like super low fee. And then now you have a market you can actually swap into your Ethereum, swap into your, your other USDC, USDT, etc. But fiat itself is a technology, a protocol that lowers the cost and barrier to making markets on DEXs. So it's not limited to stablecoins, but it's our favorite North Star.
Yeah.
And then other markets we can support is, for example, if a token issuer for a Web3 project says, I want an IDO, like initial DEX offerings that like are on the downtrend because bootstrapping retail liquidity is so hard. So it's like, how do we allow institutional market makers to offer their liquidity instead of going to retail? And the solution and the way to do that is through dedicated protocol that ensures institutions suffer no opportunity cost, get an upside for supporting these token issuers, these reward asset issuers, etc.
I say so you're creating more of a capital efficient market
Exactly.
in a way
Exactly.
Through that mechanism.
Exactly right.
Then you talked about kind of addressing the AMM. Did you say over liquidity or liquidity aspects there?
Addressing AMMs in the sense that we fiat allows for liquidity to back AMMs to deepen, the amount of liquidity in an AMM market without the lockup, right? So an institution doesn't have to now, an institutional market maker doesn't now have to pick between the APY they get on chain and the APY they get in the off chain strategy. They can combine them, right? That's generally the premise.
Okay, there's a lot to dive into here. So let's maybe start with just like the Oracle side of the business. So talk to us about just kind of like some of the use cases. Like obvious use case that comes to mind is, hey, we have a DEX and we want to make sure that these assets are traded at the right price. Take us on the rabbit hole. What are some other use cases that you see other clients doing or other people are thinking about?
Yeah, good question. So I think the best use case we've found so far is through the development of like indexes in a very credibly neutral, trustless way. Because indexes are sourcing their data from I guess institutions, whether it be the price of milk or it be like I'm not sure, the price of oil, for example. These data sources are very centralized. And so where our solution comes in is ensuring that these indexes are created without trusting the party creating them, basically. Allowing you to get data beyond the price feed without trusting the intermediary. Another good example is like in prediction markets, I'll take Polymarket as well, or the UMA protocol, which done a fantastic job at introducing optimistic oracles. Rather than trusting a committee of people to say this is true, this is not, which has proven in the past to be inaccurate in some cases. Instead, you're now trusting the zero knowledge proof of a source, that comes from a government domain, or comes from Stripe, or comes from Equifax, or some really highly trusted entity that we essentially build our financial infrastructure on, right? So this is the difference. It's like really swapping out the human in the loop for for a zero knowledge proof of a highly reputable, HTTP domain name.
That's really interesting. So you kind of talked about a lot there, actually, talking about obviously oracles just as price fees as we think about what most people think about today. We're talking really about connecting private data, institutional systems in a trustless way. What kind of data needs to come on chain, and what kind of infrastructure is missing at this point that you guys are really focused on?
Good question. So I have so many tough questions. So what I think is happening is that infrastructure is like an enabler, and then the innovators come in and identify where there are holes in the market for capital efficiency and lowering costs in ways we currently already do things, or improving outcomes for people, that then determine what that data actually is. So coming back to our example of like indexes, it could be any data, right? It could be data sourced from some centralized exchange. Like the centralized exchanges, I think are a data source that we're highly interested in. And the reason why is because they're essentially their own oracle, whether it be for price of an asset, or it be for the volume of a market, or it be for a collection of various markets. Except some API requests require API keys. Some data is, personalized, needs to be anonymized. And so what we're trying to build is essentially that pipeline to say, okay, let's leverage private data and only reveal what's necessary on chain to power these systems like, indexes or fiat and so on.
No, that was very helpful. Yeah. And then I'm also just curious, what kinds of market participants are you seeing gravitate towards fiat today? Would it be like you said, maybe crypto native LPs, OTC desks, TradFi bridge builders? What are your thoughts there?
Yeah, so for fiat, our target sort of persona, or the sort of companies we're approaching, are, first and foremost, we're in open discussions with various market makers who traditionally actually only engage centralized exchanges, primarily because of that opportunity cost in the, locking up liquidity versus using it actively. One fantastic example is a company we're collaborating with out of Latin America, who's interested in making markets on chain for the Colombian peso stablecoin, right? And they already do it to some extent, except there is, I guess, that rigidness like I've just described. And so offering them that ability to be capitally efficient, minimizing the amount of peso they need to hold on hand in order to serve that market, right? Not having to hold 50-50 USD peso, but instead like 99% USD, 1% peso. Unless the market demands the peso, then they can rebalance accordingly. Giving them that flexibility and that, impermanent loss minimization.
I actually want to dig even deeper. This is good. So okay, there's this market maker that comes. They, like you mentioned, they don't want to hold the Colombian peso. So how do you kind of leverage that dollar to create more of these pesos?
Yes,
If that's the right question to ask.
Yep. So it's not that the dollar creates more peso, but holding more dollar alleviates the risk of the inflationary risks associated to the peso and these other fiat counterparty assets, right? That's one of the biggest hurdles in crypto FX, is having to lock up your Nigerian naira, or your Australian dollars, and it's just a weaker currency overall compared to the USD or the euro now. And so what happens on the back end is that a market maker can rebalance accordingly with their own OTC counterparties, right? They're the centralized exchange that they want to engage with. What happens beyond the market maker is totally their responsibility, but giving them the flexibility to rebalance dynamically and not be locked into what the AMM says they have to hold is I think that a net benefit.
It sounds great. I just have to hold USD, but now how do I get the rest of that
into peso,
Colombian peso, to support that market? Yeah.
Right.
So
Yep. Good question.
Let me kind of tee it off for you. So,
Sure.
Okay. So what you're saying makes sense. So let's give us kind of a real example. So somebody is a market maker. They have all this US dollars. and they want to deploy it into an AMM that does the pesos. And how are they going from the dollar to the pesos, kind of balance that out?
Yeah. So a market maker that's holding a bunch of USD that has access to the Colombian financial system, right? Has a Colombian bank account, etc., is capable of engaging counterparties domestically in order to exchange USD for peso. Like there are existing foreign exchange corridors within that country, whether it be directly via banks, licensed banks, or even the central bank, right? Who would be more than willing to accept USD for their local currency.
For sure.
So that exists. In Australia, as a matter of fact, converting USDC to Australian dollars for people that don't have access to interbank OTC, actually get it cheaper than if they were to do it USD to AUD, because just USDC is so accessible, right? You can get it at any centralized exchange. It's so easy to hold. You don't need US financial infra to hold it. And so that's the premise here. It's like if there are market makers who aren't necessarily these foreign exchange players, but they have low cost routes from USDC to their local currency, whether it be from a centralized exchange that's operating domestically or an OTC counterparty like a bank or so on, those become corridors and liquidity routes that become accessible to the DEX market that they're making. That makes sense. So it's like extending the AMM's liquidity pools out into the real world.
Yeah, so they could maybe borrow from an OTC desk some more the Colombian pesos.
Yeah, they can borrow, they can engage directly, they can like do forwards, non-directional forwards, any sort of like, they can do a whole bunch of things now off chain in order to just rebalance however they see fit based on the market dynamics, and just ensure that they have, the fiat that they need in order to make that market. Once they have peso, they can just transfer it to the issuer, and the issuer gives them back the tokenized version.
Got it. Okay. That's interesting. So maybe you talk to us then about how does Fiat solve for settlement risk in that environment?
That's a fantastic. We've gotten this one a lot. Of course.
All right.
So what Fiat does is it works on the basis of course, generating proofs that guarantee that liquidity is available, meaning that a market maker cannot commit more liquidity than they have on hand, of course, but then also requires a little bit of that liquidity to be settled up front. And that sort of, we call this like a base value to signal threshold that you have to cover, but it might be 1 or 2%, right? And that forms collateralization, essentially. And what that allows for is, if in the case that a market maker fails to settle, another market maker or some guarantor can intervene and essentially settle on their behalf in exchange for their collateralized liquidity position on chain. And so you get this dynamic that operates similarly to what we see with liquidation risk in lending markets, but without the sort of trigger based on price fluctuation. It's actually an operational risk that triggers that seizure of that collateralized position on chain. Now, I know that's in depth a little bit. So for anyone listening, that we do have documentation and a tech spec and a paper that I can share if you're interested.
That's good.
That's great.
What else are you seeing in the DEX market? So, obviously we have DEX, we have hyper liquids, been pretty popular recently. Kind of talk to us about what you're seeing on the DEX side of things in general.
Yeah. So a lot of the problems that we're tackling have led or are in the same sort of, I guess you could say, like sphere of discussion with, clubs, central limit order books versus AMMs, right? So central limit order book club versus automated market makers. Hyperliquid is, I guess, probably the most successful decentralized central limit order book. And the outcome of creating a central limit order book is getting parity and as close to a UX as what you get with Binance, right? Or Bybit or your centralized exchanges. And market makers love that, right? You just manage an order stack. You can deploy as much liquidity as you want and concentrate it around, however you want. You get a lot of freedom with how you just, distribute and allocate liquidity. Whereas AMMs are extremely rigid. Their simplicity allows for distribution on every blockchain, but at the same time, it requires you to lock up liquidity and allocate it, in a very specific way. And so what we're trying to do is allow AMMs to deliver on what central limit order books are doing for market makers and for high frequency traders, and give that flexibility in terms of how liquidity is managed and distributed, while also allowing for compatibility with all these various blockchains that allow for PancakeSwap and Uniswap to exist.
Yeah.
So I think DEXs are an interesting spot right now. We're also seeing like a lot of volume coming into DEXs. So DEX is actually increasing with respect to like, the volume and how much people are engaging with them. And so, I mean, this is there's a theory. I don't have any hard evidence on this, but this is a lot of why like centralized exchanges are deploying their own layer 2s.
Interesting. Yeah, that's pretty fascinating, actually. Yeah, when you think about that in the ecosystem.
How about with RWAs? What are you guys seeing in the RWA space? Is there different ways you guys are work with RWAs as well?
Yeah, so RWAs offer like a big promise, of course, getting access to yield that comes from basically anywhere outside the blockchain. What we're seeing is like issuance of RWAs is like like the standard approach to doing it is to ground yourself in regulation and compliance. And we've seen that with like Ondo, I think, was a great example where, they brought in a really reputable auditor. They set out a set of compliance standards to, for people to trust that they then complied with to, ensure that their assets are, are valuable. I think with one respect, like these same compliance standards could be cryptographically enforced. So coming back to our infrastructure, there's a way that you could, for example, use zero knowledge proofs to automate a lot of what a third party auditor would do, right? Here's how much is in our bank account as reported by this API that comes from the bank, right? And that becomes your against proof of reserves, I guess. So that's one aspect.
Right.
The other aspect is that like these are still tokens that need to be issued. They still need listing on an exchange. Getting listings on centralized exchanges, there's a high barrier to entry because you need to go talk to the token listing manager, et cetera, et cetera. Whereas listing on a DEX is free, right? Except it requires bootstrapping liquidity from retail. So with RWAs, what we're in talks for supporting is, again, lowering that barrier to list on DEXs by allowing the reward asset to be supported by a market maker, right? Lending that to a market maker and having that market maker come in with their own liquidity to list on a DEX. And then having that RWA exposed to all of the subsequent DeFi protocols that depend on its exchange.
Yeah, that makes sense. Going back to what you said about proof of reserves, how does that work in the fiat ecosystem?
Yeah, so what we're doing with fiat is you can think about this like a ZK rollup of data that comes from various centralized exchanges on behalf of market makers, right? So a market maker will come in and say, hey, here's a read-only API. You're the only party that can access our data. And what we would then do is roll up a bunch of proofs associated to the fact that they do indeed have this amount of liquidity they want to commit to various markets. And only reveal that data, right? No API keys, no identity, full data privacy. And so that in itself acts like a proof of reserves mechanic, but it also is like a solvency check, right? And so applying that same paradigm to reward assets is could follow a similar paradigm where there is some set of compliance requirements that are cryptographically enforced, that ensure that your token cannot be minted arbitrarily. It follows a pattern in order to be minted. You know, ensures that its liquidity actually exists in this specific location that you said it exists, and that the protocol is built around. And so that's how sort of the infrastructure plays a role with fiat, and how it ties into what RWA tokens can do as well.
Yeah. I guess maybe too, when you think about institutions kind of getting into space, we talked about that a little bit, whether it be banks, maybe centralized exchanges too, but usable on-chain activity, right? Institutional reserves, if you will. What do you see as the biggest blockers right now, current state, for that to kind of roll out at scale, based on kind of what you guys are building here?
I think lowering the opportunity cost to getting into DeFi is obviously the first thing. So you can think of like market makers or institutional players. I guess there's like two various types of institutional players. You have your passive sort of funds, right? Your ETFs. They sort of just buy and hold.
Right.
And then you have your like high frequency traders, your flow traders, your Presto, your GSR, etc. And these guys are like allocating liquidity for partners to make markets and to sort of make these, I guess, environments exist. So for the latter, I guess, is where we're mostly focused. And yeah, the blocker there has been, what are the opportunity costs for them to get involved in DeFi, and how do we lower those opportunity costs? How do we make it beneficial, and offer ROI that exceeds what they're currently doing? Yeah, that's generally the most primary blocker. In order for that to happen, though, it's just been a technical challenge. So having the technology to facilitate, again, that bridge between what's happening off chain, what's happening on chain, and then modify what's happening on chain to account for this liquidity that's not yet tokenized or not yet on chain, is the second blocker. So I wouldn't even call it a blocker. It's just a very difficult technology problem.
Yeah. So you mentioned the incentive mechanism, the ROI, and the technology or technical aspect there.
Yeah.
That makes a lot of sense. Yeah, it definitely makes for interesting times when all this is happening.
Yeah.
In real time.
For sure.
Yeah.
Yeah, I think now's the time for like innovation. I mean, I feel like the ecosystem's constantly evolving. What are you guys seeing? I mean, you guys have like direct exposure to institutions. You work with market makers with what's being done with the TIE. How are you seeing the sort of, I guess, involvement of these players in DeFi and so on?
Yeah, we're seeing more and more of it. I mean, every institution is getting into crypto, and in one way or another, whether it's an ETF, I've continued to see more like RWAs. So more people getting into space from an RWA perspective, tokenizing new things. Like we seen recently, Robinhood. They're going to be tokenizing like private shares of companies, which is unique. It's like they're diving head first. We haven't seen a lot of this recently.
Yeah.
So I would say those are some of like the biggest trends, and obviously like the digital asset treasuries in the last week have just become the topic of the town. Everyone seems to be launching one token or another.
Definitely.
Yeah. And to your point earlier, you talked about kind of the layers of the infrastructure too, which I think is interesting. When you think about the ETFs that have been created, and now you have ETFs are going to be staking, and then you have the underlying components of what that looks like beneath the surface and how people need to affect that process. Because a lot of these institutions don't want to touch wallets, right? They don't want to touch that layer of technology, but that is important from a foundational aspect. So it's interesting to see as you peel back the onion, all these different pieces to the puzzle that need to be built or already built that need to be integrated. To your point on an evolution that's happening, and very quickly.
Yeah. I totally agree. I think like there's going to be this abstraction layer between like how regular companies engage crypto versus what's actually happening under the hood, like you just described. Do you think there'll be an ETF for like liquid funds? Do you think it starts getting like into high risk outcomes? I feel like right now it's pretty low risk. We invest in Ethereum and that's it, or we just do validator staking.
Yeah, it's a great question. Well, we'll see what happens. I think there's a lot of, I mean, there's obviously on the private fund side versus the public, we already see a lot of
Mm,
things happening in real time, what people are doing. I think some of that eventually will spill over into
yeah,
the public ETF space, just because of the
yeah, for sure.
opportunity, right? I mean, and then to Mike's point earlier, what's happening to treasuries is a huge conversation
Yeah,
that's happening every single day of the week
yeah,
right now.
yeah, yeah. I feel like strategy really
Yeah,
paved the way with that. But I think Ethereum's really
Oh, they
taking off.
did.
yeah.
There's like,
It's kind of
Oh yeah, they
crazy.
created.
Kind of crazy. It took
Yeah,
like 4 years for other people to start replicating
exactly.
what they're doing.
Yeah,
yeah,
I'm actually really curious
yeah.
about that gap. I mean, it's like 4 or 5 years of nothing, and now all of a sudden you're just seeing every single company jump into it.
yeah.
Right. And then the tokenization aspect that people talk about, and Mike mentioned, everybody's trying to tokenize something. And then you get, it's kind of funny how things come in waves like, oh, it's tokenized this and that or the other. Let's have a tokenized fund. And by the way, can we take that token, lock it into a DeFi protocol and enhance the yields of the fund? Like there's all these different things people are
Mm,
trying to do in real time, lending, and borrowing, and a smart contract mechanism with tokenization. It's just adding to the complication, but also trying to chase the yield too, right? That's always been the case for anybody you
yeah,
talk to. How can I do it faster, quicker,
for
and make
sure.
more
That's
money?
like the key value proposition in this whole space.
Right.
It's how does zero go to one like tomorrow? Um,
That's
I
fair.
think
Yeah.
go ahead.
Oh no, go ahead. Go.
No, I was just going to say I think lending and exchange are like the two most primary aspects of this whole thing. Like, I think stocks, like coming back to like the whole tokenized stock aspect. I think the biggest premise is like, okay, exchange via a traditional broker firm might be more cost effective than trading on chain. But then what you get on chain is the ability to borrow against your stocks, right? Which is inaccessible to a lot of like retail, to a lot of like players out there. I don't know. I thought I'd just throw that in.
Yeah, I like that. Yeah, you
Yeah,
get the lending aspect. I mean, you also get the 24/7 aspect too. You can trade on a Saturday afternoon.
Exactly. Exactly.
it's
Yeah.
huge.
Anything else you're like really excited about right now, Ryan?
I'm interested to see like more generally like how what happens with the whole like fiat to crypto merge. I really think like that space, like the infrastructure for crypto is going to be merged into the existing financial infrastructure. But I'm excited to see how that plays out. Um, you know, do stable coins become like the conduit for what CBDCs were? Like this is like a scary slash potential concept that is being introduced. I don't think it's sort of the same thing, but it's an interesting way where stable coins become more like utilized for everyday sort of things. Whereas like then on the other aspect, it's like, does every country hold Bitcoin? Right. So that's another thing. Like, is
Yeah,
there a Bitcoin treasury for everyone? Is there a flippening that happens? Does Bitcoin, what happens to Bitcoin, miner rewards is another interesting topic that no one talks about. It's like, does the infrastructure to run Bitcoin cost more than the rewards earned eventually? And then what happens? Yeah. So there's quite a few interesting things on the horizon for sure.
yeah. I always think about too just how things just in that like talk about the merging of traditional finance or TradFi. Um, People were losing their minds over just the T+1 settlement, right? Going to that
Mm,
process, how fast that will change things, which is pretty
exactly.
interesting. I didn't even think about just. I'm curious of your thoughts here. And this is more of a highly philosophical question, but like, will DeFi eventually replace prime brokerage and market making, or just reshape the back end of how it looks on the surface, right? With the rails and everything that's happening. And to your point, stable coins, the merger of both sides, how they're used, what utility, and it's just, is it just as we move forward with other things, just another asset class in the space that gets absorbed into the ether of the entire ecosystem? I don't know.
Yeah, that's a great question. I haven't really thought too hard about. you know, about this particular aspect, I feel like I feel like what operates DeFi are these players that function as prime brokerages or
Hmm.
function as market makers. Like take lending for
Right.
example. Morpho is built on the premise that there are these curators, for example, and they, in a sort of trustless way, manage and rebalance how liquidity is supplied to various markets. So I think these
Yeah.
players actually work with DeFi, and what DeFi ends up doing is adds price discovery for just about anything, right? Adds sort of real
Yeah.
time accessibility to just about any asset, right?
Mhm.
But for that to work, it needs to have these players like you've just described, participating in either making a market or curating a market, or
Mhm.
functioning as the bridge between and the brokerage, between their clients and the markets. So yeah, I think that's how it plays out. Yeah.
Yeah. Yeah. That's interesting. And even, I guess you brought up early on in the conversation, touched talking briefly a little about AI. Can I think about like this whole AI agent aspect of what we're talking about? You have the orchestration agent, you have the curation agent. They all work together to move the ecosystem into an equilibrium or
Yeah.
balance
Yeah.
Yeah.
daily basis.
Like what you're saying about the DeFi too, Ryan. It's kind of interesting to think like having this conversation like it's almost like the AMMs could kind of be like the pre-hyper liquid. It's like you could
Right.
kind of build a market, find some price discovery, and then when it's big, I don't want to keep my assets in AMM. I'd rather put them on a liquid order book.
Yeah.
Right.
Yeah.
Right.
We
Evolution.
hope we could change that. we hope we can make
Yeah.
AMMs as capitally efficient as order books, but no, that's definitely what happens. I think every exchange offers some unique value prop that outweighs the other. So like Binance, for example, centralized but extremely liquid, right? Probably more liquid than what you can get on any DEX. Hyperliquid offers like the best perp exchange experience ever. So, but then what you can do with spot might not be as free as what you can do with AMMs. Whereas like with the hyperliquid you need a bridge out. It's like, do they support bridging of every currency? Not sure yet. Whereas AMMs are just like token in, token out. I know what I'm getting. But yeah, coming back to your point, I think what we'll end up seeing is similar to how blockchains have functioned. Like each exchange or each DeFi protocol will have its own unique value prop, and its value relative to its competitors will end up, materializing into how much it's used and what it's used for.
But yeah, Ryan, I appreciate taking us down the rabbit hole here. Tell us about just kind of the future for Fiat and for Usher Labs. Kind of what do you see coming in the next couple of years?
Yeah. So, I mean, right now we're pretty heads down and focused on trying to build out their Fiat protocol. We're going to be launching initial markets on Arbitrum, but of course we're in talks with the other chains like and partners out of the CeeLo ecosystem, out of Stellar, for example. And so, ideally, our long-term vision here is lowering the cost and barrier to initial DEX offerings and just DEX listings, whether that be for your Web3 project token or your reward asset, or of course your stablecoin, your fiat-backed stablecoin. And then through fiat-backed stablecoins, I think by lowering the cost to listing, by creating super liquid markets, allowing traders to go from USD to Australian dollars for less than they can go, less than what it costs to go through Wise, for example, then we can start contributing to remittances, global remittances, and potentially even foreign exchange, in the sense that anyone who doesn't have access to these interbank market, mid-market rates, can now get a super affordable rate via blockchain rails. That's generally the North Star that we're trying to achieve in the next few years.
Yeah, love it.
Amazing.
Awesome. Well,
Very
where
exciting.
can people go to connect with you, learn more about Usher Labs, and what are the type of people you want to reach out to? And you mentioned like Dexes.
Yeah, sure. So you can find us on Twitter at Usher_Web3. And you can head over to our Discord as well at go.usher.so/Discord. And you can chat to me there if you'd like, chat to the team there. Who we would love to speak to, market makers, if you're interested in speaking and getting involved in DeFi. If you're not already, feel free to reach out. Token issuers, of course, if you're looking to, if you're interested in the idea of listing on a DEX without the overhead of releasing a bunch of tokens to retail in order to get them to support the market, feel free to reach out. And then if you're a DeFi aggregator or a DEX aggregator, etc., we'd also love to chat.
That's great. Well, Ryan, this has been a really fun conversation. Appreciate you jumping on. We'll make sure to include all that information in the show notes. And again, thanks for joining us.